Morning, Cullen.
Good morning. How are you?
I'm good, man. How are you?
Awesome.
Thank you.
In New York.
Yeah, man. Well, thank you for coming in for this.
Yeah, for sure. You too.
Well,
You probably came further than I did.
yeah, but I've got a whole bunch of interviews I've got this season. And thank you for our gift.
Oh yeah, we were double Peter Schiffing today.
We're gonna.
I want the audience to note that my Schiff is bigger than Peter's Schiff. So
Bring that in a bit closer. I think that's going to start a meme now. And I can imagine about a year I'm going to be traveling with a fucking case of Peter Schiff photos all up over the wall. I'm so glad to talk to you. I really want to talk to you. I like to have a range of people on the show. People who support Bitcoin to people who are anti-Bitcoin and people who understand different forms of economics. And I want to learn from everyone. And I was trying to understand a little bit more about Austrian economics. And as I told you, I did a search for critics of Austrian economics, and I found an article that you put together. In fairness, it was back in 2013, but it brought us some interesting points, and so I reached out to you, and here we are. But I want to talk to you about a few things. I want to talk to you about inflation for sure. I do want to talk to you about Austrian econ. I want to talk to you about the economy at the moment because we're in a fucking wild place, man.
yeah.
So yeah, where should we start?
Let's start with inflation. I feel like it's the topic of the day, right?
Yeah, so I listened to a show you did on Preston Pish's network discussing inflation, and it was super useful to me because I feel like sometimes Bitcoiners are very quick to jump on inflation, sometimes almost in a celebratory kind of way, even though it's shit for people.
Yeah.
But is we were right. But your key point was that like not all inflation is down just to the money printing, right?
Yeah. Yeah. Well, I mean, that's the really I think one of my almost like most frightening discoveries of the last like 10 to 15 years. And I focus on inflation so much in my career because, so for people who don't know, I'm a financial manager. So I manage people's portfolios. And to me, understanding inflation, if you could pick one variable in the whole world that you had to understand that would be like your go-to indicator, inflation would be the thing to me. Because you tell me what the rate of inflation is in 20 years, I'll tell you pretty much what most financial assets have done, whether it's Bitcoin, bonds, stocks, whatever. So I'm hyper-focused on inflation and I think a lot of people approach inflation from a very politicized perspective. And they'll argue that inflation is going to do this because, for the most part, people are either pro-government or anti-government. And so they kind of take like a hardline stance. And I've spent most of my life trying to find like the nuance there. And the really like I think jarring discovery for me is that nobody really understands what causes inflation. Like the really simple theory obviously is more money, same amount of goods, you're going to get higher prices. But the reality is that it's a fuckload more complex than that. And we see that in especially like developed world countries like Japan in the last 20 years, where you have a lot of like weird things going on in the Japanese economy that despite the fact that they've created, an economy now that has 300-400% debt to GDP, they seem to have, printed just incredible amounts of money and they still have virtually 0% inflation. And so I think the conclusion that a lot of people have come to is that, well, it's a lot more complex than just the money printing aspect of it. And there's all these other things that come into play, like demographics and inequality and all these other sort of like somewhat subjective measures that make it really hard to measure inflation and understand what's going to cause it. But, to your point, I think, I talked to Pomp in April of 2020, and the Bitcoiners were right that the government response to everything that happened during COVID was going to cause inflation. And so, like looking at the price of Bitcoin today, I'm still shocked at the rate of change that has occurred, but the fact that it's gone up a lot is not super shocking. I would say, God, the rate of change in virtually everything has been somewhat shocking, even like the stock market and whatnot. But yeah, the Bitcoiners were right, I think, because in this specific instance, I think it was the government response, and this was something that I was saying at the time, the government response was so big and it was so different. I mean, I cut my teeth in the inflation world and really like trying to apply all this during the financial crisis. And a lot of like my understandings of this come out of the financial crisis and the government's response. And my basic conclusion coming out of the financial crisis was the Fed's doing a lot of weird stuff, but really the Treasury's not doing a lot of stuff. And to me, that's the money printing that occurs in the economy is very different between those two types of entities. And in my opinion, it's the Treasury that really has the money printer. And coming out of the financial crisis, you didn't have a huge Treasury response. This time around, it was totally different. And so I think that's a big part of why we've gotten the rate of inflation that we have. So it's a weird thing. Inflation is different in everyone's personal instance. It's different in every country's instance. So, the way that a big government policy or inflation dynamics would affect like the United States are totally different than, like if Zimbabwe printed trillions of dollars like the United States, well, it would have a totally, totally different impact because their economy is totally different. So it's another variable that just makes understanding inflation so difficult and predicting it virtually impossible, which is, from a government policy perspective, is sort of frightening because you can get into situations where you have people that are, dictating policy and doing things that could cause things that they literally cannot predict and, are just potentially a lot more catastrophic than people think.
Right. Okay. I think it'd be really useful to try and look at the formula for inflation, even though we can't define which factors, come together to affect it the most. But to understand the things that would go into a formula, the different things that could do it. I think we should start even simpler, though. Like, if somebody said to you, like, what is inflation? How do you define that?
Well, from a really textbook definition, the definition of inflation is the rate of change of a basket of goods and services. And that's really vague to some degree, but a lot of this, like I've studied the Bureau of Labor Statistics approach to CPI and stuff. And, I used to be like, for background, when I graduated, I actually was a pretty like hardcore Austrian econ guy. So I'm still like I'm obviously like I wrote a book called Pragmatic Capitalism. So I'm obviously like kind of a hyper capitalist, but like I also I started studying a lot of this stuff because like if you want to understand inflation, you've got to understand the way that the BLS measures it, because places like bond traders, like all these guys trading bonds down here, they don't give a shit about the shadow stats measure of inflation. They don't care about the Chapwood index or your alternative index. They care about the CPI, because the CPI is the index that the government dictates all of their policy off of. It's the indicator that the Fed dictates all of their policies off of. So you have to understand the way that they measure it. And measuring inflation through a basket of goods is really messy.
Well, this is why I asked you, because as you said before, inflation is really subjective to you as the individual.
Yeah.
Just my sense, like in the UK, it's not hitting us as hard as it's in the US. So even between trips, I'm noticing things getting massively more expensive. But I suspect there's different things at play. So, for example, my flights are super expensive right now coming over. My flight to Miami was probably double what I paid early in the year. But I don't think that's inflation. I think that's the industry responded to coming out of COVID and trying to fill their planes, but not filling up their routes. But I have noticed, it doesn't matter where I go for dinner or lunch, like buying a sandwich and a coffee seems super expensive.
Yeah, it's way more.
I'm trying to buy a house at the moment. That feels super expensive. So this 6.2% rate we're seeing, I do not believe, for me, it's 6.2%.
Yeah.
I think here in the US, when I'm spending money, I think it's 15 to 20% year on year.
Yeah, well, I mean, to somebody who's trying to buy a home right now, or if you're renting, I mean, it probably even feels higher because like for a lot of people, you're waiting in shelter. Like, for instance, the BLS rates that the shelter waiting in the CPI it's something like 32% or something. And, that's not true for everybody. Like for a lot of people, it's probably a lot higher than that. If you live in New York City, I'll bet it's a hell of a lot higher than that. So it's super personal, but also like in the United States, like I live in California where it's virtually impossible to build a house because the regulatory system is so jacked up. And Californians are consistently complaining about, oh, house prices are too high, what do we do? And it's like the obvious answer is, well, you build more houses. Like let builders build more houses. And it's really hard to build a house in California because it's expensive and the regulations are crazy and there's endless hurdles to jump through. So you have this like really unique supply constraint problem inside of California where there's literally not enough houses. And so the inflation in California real estate is different than the real estate inflation in, say, Arizona, which is, right next door. I know builders friends of mine who have left the state of California to go move their businesses to Arizona to be able to build houses because they can walk into the building department, show the guy a piece of paper, and the guy will put a stamp on it. And they'll walk out and go build a house. Whereas in California, it's like this big back and forth. So you get all these like weird, unique, aspects of inflation like that are really unique to not just locations, but people and things like that.
Right. Okay. So let's talk through the different elements, and let's talk about the money printer itself, the growth in the money supply. The M&T people would say, we talked about those before, growing the money supply is fine as long as you keep inflation under control. And my expectation that as somebody who doesn't understand economics is that a gradual increase in the money supply is okay. We've seen a huge increase in the money supply over the last year, maybe 2 years. Yeah. And all the Bitcoiners and the Austrian economists predicted inflation would come, and inflation is hitting. So while sometimes it's hard to predict and it's nuanced, is there a certain amount of expanding the money supply that will almost certainly lead to inflation, or is it combined with something else?
Yeah, well, I mean,
is it combined with coming out of COVID and there's a sudden demand shock?
Yeah, I mean, COVID's unique because there definitely are, like I think a lot of liberal economists right now would argue that this is mostly a supply constraint thing. I'd argue it's mostly a fiscal policy thing that, we printed a lot of money, we created a lot of demand. And yeah, I mean, there's weird stuff happening with like, the LA ports, but like if the demand wasn't so high, you wouldn't have problems in the LA ports. The LA ports would be empty or, at half capacity. So, the two are interconnected to some degree. But like, it's interesting, using the word money to me it's a weird thing to talk about because I think in the last like 15 years, the definition of money has become, somewhat subjective because like coming out of the financial crisis, for instance, this was a point I made really repetitively, almost to the point where I wanted to blow my own brains out. But like the Fed, technically, they create something we call money reserves, okay? Mm-hmm. So when they do QE, quantitative easing, they create money and they essentially swap a bond for reserves, okay? So keeping things really simple, the Fed expands their balance sheet and they go out into the market and they buy existing private sector bond or government bonds, and they literally are swapping the balance sheets. And so something that I tried to emphasize coming out of the financial crisis was, well, if the Treasury isn't doing anything, if the Treasury isn't expanding their balance sheet and spending more, then there's an outstanding balance of bonds. So when the Fed comes in and expands their balance sheet and swaps those two assets, well, what happens? From a technical perspective, you have fewer bonds in the private sector and you have more money. Do you have more financial assets though? So it's almost like it's a weird thing because the Fed takes these bonds out of the economy. They put them, the Fed's balance sheet for practical purposes is like a black hole. It might as well not exist. Like theoretically, the Fed has, hundreds of gazillions of dollars on their balance sheet in theory. But in reality, the way that the Fed mostly operates is they expand their balance sheet and then they do these asset swaps. And there's lots of debate about, how impactful those asset swaps are. Do they cause asset inflation? Do they make people chase, riskier assets, things like that, which is a totally valid debate. But from a really technical perspective of the way that we define things like money, all they've done is they've swapped what is in reality a checking account with a savings account. And it's one of these things where, think about it from your own perspective. When you swap a checking account for a savings account in your own financial life, $100 for $100, do you think of yourself as having more money? So you get into these like silly debates about what is money, are government bonds money-like? So you get kind of caught up in these debates where, for me, it's much more useful to look at money as existing on this like scale of moneyness. Okay. So I like to think of money as, there's things like bank deposits and reserves or physical cash these things are hyper money-like. I mean, you can walk into virtually any store in the world with $1 and use a deposit or physical cash to buy something. A treasury bill, it's a little, further up on the spectrum where it's more difficult to use a treasury bill to buy things. But I mean, for instance, the guys that are, all around us on Wall Street, they use treasury bills and treasury bonds to buy other stuff, collateralize and, buy other stuff all the time. So you have this weird market where, you can use T-bills in a very money-like sense in other financial markets. Bitcoin, is Bitcoin money? Where would it fit on a scale of moneyness? Well, I mean, increasingly, it's becoming a lot more money-like because it's becoming more widely accepted as a medium of exchange in places. So, its moneyness is increasing over time, but it doesn't have, I would argue, the same level of moneyness that like a physical dollar does. But you get into all these debates about, the level of moneyness of something or the scale of moneyness of something, and it's weird. In some environments, some things have more moneyness than others. Like treasury bonds become hyper money-like when the shit hits the fan. So typically when things go really badly in the economy, the demand for treasury bonds increases because people want to hold that thing that is basically a really safe savings account, basically, relative to other financial assets in the world. And so,
as long as the US doesn't default.
Right. Yeah. So assuming, but I mean, in today's world, the treasury bond market is just by default mainly because all the other bond markets are shit. It's by default the dominant bond market just because on a relative basis, what's going to compete with it? Mm-hmm. There are no Euro bonds really. Chinese bonds, who the hell would trust, government-issued Chinese bonds to the same degree that treasury bonds would? Yen and Japanese government bonds, close, but still not nearly the same size and quality. I mean, and this is, one of the interesting things that, the points I like to make about treasury bonds is I think sometimes people think treasury bonds and things like that are, have value because they're backed by the government or the military, and I kind of think that's silly. It's literally because the U.S. government just happens to be the entity that can tax the most output in the world. So it's a function of the productivity and the gross, output of the capitalist system in the United States that makes treasury bonds valuable. Right. It makes the dollar valuable, really. It's not the other way around. The dollar isn't valuable because the government is great and because the government, has a great big military. It's the opposite way around. The dollar is valuable specifically because the people that use the dollar to invest and build things have created a lot of value that has created a lot of demand for the dollar. Right.
So how do we measure the growth in money supply? Sounds like you can't, really.
It's hard. I mean, using something like, coming out of the financial crisis or even COVID, I mean, I think you can look at the way that the government is responding to things like that, and you can measure, at least to some degree, the rate of change of these things. So, for instance, in 2008, 2009, the government as a whole, meaning the Treasury and the Fed combined, their policies weren't nearly as big as I think a lot of people thought they were. They were big, but they're nothing compared to like the COVID response. So, like the Treasury's recovery package was like $800 billion in 2008, which was, by size in that time, seemed like a big number, but
Not now.
We just spent like, we ran deficits of $7 trillion over the last 2 years. These are huge, huge numbers. So, measuring it is really imprecise because it's just, you get all these like M1 went up a lot like a year ago. And part of that was just literally the Fed changing part of the definitions of the way they define savings deposits. And so you had this like numerical increase in M1 that for practical purposes was literally changing a checking account and a savings account, the way that they define it. But I mean, looking at things like M2 is at least a somewhat useful measure because when you combine it, when you look at the government in totality and you understand, okay, well, the U.S. Treasury really did print $7 trillion of new financial assets. That's real. It's almost cleaner to look at Treasury bonds as money because then you can look at the size of the deficit in government debt and you can say, in a pretty clean model, let's say that the Fed didn't come in and monetize the bonds, and let's just say that like the Fed wasn't a thing. The Treasury comes in and literally finances their spending by printing actual money. The literal money printer is actually in the U.S. Treasury, the Bureau of Engraving and Mint. That's where the actual money printing is done. The Fed's kind of this like back actor who, gets a lot of airplay, but like to me, the Treasury is the one that, they're the real bazooka holder. And if you look at government spending and deficits and government debt through the lens of viewing government bonds as basically money, there's no measure through which you can argue that we didn't print a ton of financial assets or print a ton of money in the last 2 years.
Do the Fed and the Treasury work closely together, or are they completely separate entities with separate remits? And they
super close.
Super close.
Super close. So, I mean, technically the Fed is part of the Treasury from a legal perspective. So like a lot of their actions are coordinated, and a lot of it in a weird way is kind of weird hocus pocus to some degree, because it's like the Treasury will run, a huge deficit in year one, and the Fed will come in and legally, because we define the Fed as like this independent entity, they're not technically supposed to be able to buy the bonds. Like they can't finance the government's debt directly, but the Treasury will, run an auction, and the primary dealers, who all work for the Fed, will buy the bonds, and then the Fed will buy the bonds from the primary dealers. And it's like, have we kind of just created this like weird legal distinction of like, the Fed being independent, where like if you look at it from a really like nuanced operational perspective, like, yeah, they kind of look independent, but really they're not. And if you actually consolidated them and combined them, you can see that a lot of their actions are just, they're really cohesive.
How much does economic growth play into inflation? So if we were in a period where, say, there wasn't a massive increase in the money supply, but can economic growth itself drive inflation? It feels like it should, because it's supply and demand, right?
They correlate. Like this is one thing, and this is a point I often make to Bitcoin, mainly Bitcoin maximalists who argue about the deflationary aspects of Bitcoin, that to me, money is actually mostly credit. Okay, so like in the United States, the money supply is mostly controlled by banks. So I could walk into a bank down the road and I can take out a loan. And when that loan is created, that loan creates a deposit. And I can take that deposit, which was literally just created out of thin air by this bank, and I can go buy whatever I want with it. That's the dominant way in which money is created in the United States. And so it's not it's not a decentralized system, but it's fragmented in a way that the private sector banking system has a certain amount of control on the money supply that, in my opinion, is a pretty good way of managing things relative to like, the alternative is having like the Federal Reserve be the only bank in the country. So you would literally go to like a bureaucrat to get a loan if you wanted, and that becomes a really messy process, because it's obviously it's like highly politicized, and whereas when you walk into JP Morgan, as shitty of a bank as JP Morgan might be, the guy on the other side of the loan processing desk there, he's looking at it from a pure money-making perspective. It's a very market-based, money-creating type of system, the loan creation process. And so, but the kicker, like with your question, is that the majority of economic growth is a function of credit growth. So, like in the United States, the majority of money that exists is really just real estate based. People take out mortgages to buy homes, to build homes. I mean, there's this really like weird, strong argument that the US economy in a lot of ways is basically just a big real estate market. And when the real estate market goes to shit, the whole economy goes to shit. But
which we saw.
Yeah, but the kicker with that is that when it's compared to or combined with the way that the credit markets work, well, the majority of what's happening with the money supply and credit is mostly just people borrowing to buy and build homes. And so the money supply, in a sense, it's kind of always expanding because credit's always expanding, because there's, you know, one of the nice things about having an elastic money supply, elastic meaning that like it can grow and contract, is that if Peter's got all the money in the world and I have none, but I want to build a house and I'm pretty good at building houses, I can go to a bank and maybe I can convince the banker to give me a loan, which will create money, which will allow me to build and finance this house. And when we're all done, I'll have a loan that I need to pay back over time, but I'll have a real financial asset that I've just built. We have this house in the economy that is a totally endogenous asset that it provides real value to the economy, and it's something that it's a real asset that's generating real demand for money and backing the supply of money that exists. So, you know, it's one of these things where, like in my example there, the money supply has technically increased because the supply of loans and deposits has increased. But, you know, is that necessarily going to be inflationary? That's, you know, again, it's a weird question because we've created real assets that support the money, but we've also created a system where the new loan has created demand for, you know, things like lumber and concrete and building materials that otherwise didn't exist. So it depends. I mean, like in the long run, my argument would be, you know, a credit-based system like this, does it need to be inflationary? It doesn't need to be, but it is predominantly because the process of building that home is a messy one. It's the supply constraints are messy, and in the long run, you've got an expanding money supply that will result in more demand than we would have otherwise had. That, you know, I think a low or moderate rate of inflation in an economy is not necessarily a sign of dysfunction to me, especially in a credit-based system like we have. The thing where you can get, you know, a dangerous situation is when the government, as a huge credit creator, they can get involved in a way that you could collapse the whole system if they tried hard enough. Because that's the other thing. The government isn't competitive in the same sense that you and I are. When I go out and I build that house, I'm hypersensitive about the cost of things and the productive way in which I'm going about that whole process. Whereas the government, in a lot of cases, they'll say, well, California needs more homes, so why don't we just print $1 trillion and send it to California and let people go crazy with the money? That's a totally different process than like a competitive bidding process. And that's where a lot of this gets really messy. And governments are big and obviously, you know, very involved in the economy in a lot of ways.
And so do we get a crash because we end up with too much credit in the system? And essentially we have a blow off the top, too much credit, not enough being paid back. And has the economy suffered from the fact that it feels like the government doesn't want to allow crashes to happen? That's the feeling I get.
Yeah.
They constantly want to kick the can down the road because there's no political capital in the bust part of a boom and bust cycle.
Yeah.
And it feels like we're not allowing the bust to happen. Whereas this credit expansion feels like that's the boom. It takes me back to the Ray Dalio video, like how the economic machine works.
Yeah.
You know, we have credit, we have debt, but the debt never seems to have to be paid back.
Yeah, it's weird. I mean, like I always like to point out, you know, liabilities are just the other side of assets. So, balance sheet's balance. And in the long run, what you hope will happen is that, I'll build that house. The asset side increases. I still have the liability. I have the mortgage or whatever, the loan that I took out. So from a balance sheet perspective, my balance sheet should balance. But you would hope over time that the demand, the value of my home increases so that, we end up with net worth basically, or who knows, maybe I pay down some of the loan over time and we end up with some, residual net worth because of that or something. But what can happen a lot of the times is, and this is, I think, a valid argument in an environment like this, where, especially when the government is so involved, you create a lot of demand for the value or even, the excessive borrowing of things where people then bid up things in a sense where, in the long run, the value of homes is very, very likely to increase because frankly, the balance sheets are likely to increase in the long run because that's just the way the economy works. I mean, look at any long enough time horizon of assets and liabilities, they both increase. Like people are always saying to me, there's going to be a credit crash because private sector liabilities are so huge. And it's like, well, look at the other side of the balance sheet. The assets are also really huge. So that's just a function of the basics of double entry bookkeeping, that the assets and liabilities will grow. The worrisome thing is when you get environments kind of like today where the asset side grows a lot, at a rate that is unsustainable. And you get into an environment where I think there's valid arguments that, what if real estate falls by, what if the price of real estate falls by 20%? Well, everything financed inside of the last 18 months potentially goes underwater all of a sudden because we're financing a lot of this based on valuations of today. So you get these in the long run, the trend is likely to look like this, but in the short term, you can get these hyper, volatile environments where you see price increases like the run up to the financial crisis, or, increasingly it looks like there's a lot of valid arguments that, real estate, stocks, there's a lot of weird shit going on today where things, I think, things feel weird. Things feel mispriced to some degree. And I don't know about how much. I have no idea. But it feels like that people have...
Certainly in the S&P. It's a straight line up.
Straight line
up.
With
a couple of dips.
Well, and a lot of weird shit. Like when you start peeling back the layers of that, it's funny. I was sitting at dinner last night and we were talking with a client of mine, and I was talking about GameStop, and it's like, pull up a chart of GameStop and look at it. And it's like, this chart, it's flat, and then it goes, just straight up, 400 or 500% or something. And then it just sits there. And it's one of the most incredible charts in the market today because in an efficient market hypothesis world, that should not happen. That's almost impossible in an efficient market world. And so, but this has been going on for a year. And so, and there's a lot of stuff like that where it just, things went up in value and have just sort of stayed there where you're kind of it almost feels like the cartoon of Wile E. Coyote where it's he's run off the cliff and he's just his legs are spinning and it's is he gonna fall?
Well, do PE ratios even matter anymore?
I don't know. You're getting into stock market valuation. You get into, getting into the valuation of any asset class. Do bond valuations make sense today in a world where interest rates are, 1.5% on a 30-year bond and inflation is 6%? Does that make sense? Does the stock market trading at, levels that are, by a lot of measures close to the 2000 ratio? Does that make sense? You could get into the Bitcoin's one of the most interesting things to try to value in my view because it's how the fuck do you value something that doesn't have cash flows? Coming from a traditional finance perspective, for me, it's my head kind of explodes when I try to build valuation models for Bitcoin because I'm I don't know. I don't know how to where to even start with that.
We're going to come to Bitcoin because I really want to know your position on it, but I'm going to guess it for, I've got a theory on your Bitcoin position. But I've lived through a few crashes in my life. We've had the 2008 financial crisis, which was, something I lived through. I bought a house, I think 2 months before the crash happened. I lived through the .com crash. and I vaguely remember Black Monday. I think that was like late 80s or 90s? I can't remember.
Yeah.
But these things have happened.
87, I think.
If we get a crash in the next year or 5 years, whatever, if we get one, I'm not going to be surprised. I don't think anyone's going to be surprised. It's going to happen. Well, of course it was going to happen because look at all the weird shit happening. But how much are you worrying about a crash? And do you think we're on the verge of one? Or we're in such a weird position now with like the Fed, the Treasury and the government that they're doing everything as they can possibly can to prevent any crash. And almost, one more thing to throw in there, I almost feel like there's a game of chicken happening between the US and China at the moment, because everything around Evergrande itself is weird. Everything there. The how much of the Chinese market is now propped up by overinflated house prices is also weird. And it feels like there is a game of chicken, like who's going to crash first?
Yeah.
There's a lot in that.
Crashes. Predicting those sorts of like outlier events to me is just, it's such a crapshoot. Like from an asset management perspective, I'm actually a really boring guy. I'm basically, I default to the view that, okay, look at the existing, the outstanding quantity of, world financial assets, and that gives you a rough approximation of what your personal allocation should be to stuff. So, like right now, it's like if you look at like stocks and bonds and real estate, it's roughly like a third, which to me,
stocks and bonds, real estate, and
stocks, bonds, and real estate.
Okay.
So a third. Which to me, like if you look at all of the outstanding like assets in the world, like that kind of covers all your bases. If you own a home, you have a bunch of like safe, liquid cash and bonds, and then you've got some stocks, like that covers a lot of your bases there. So just starting from I'm starting from like a very traditional finance.
I was going to say, but what about, and I would stick Bitcoin and gold together for the sake of this argument. What about like hard assets like that?
Yeah, so they kind of, I would kind of put those into like the real estate bucket.
Okay.
So all the real stuff.
Okay, hard assets
I think
together.
you can kind of like, and that would roughly work out to like a third. So you can kind of, I'm being a little loose with all this, but like, my point is that like from a diversification perspective, the more diversified you are, the more all-weather your portfolio is, meaning that you don't have to worry about, is the market going to crash next year, because you've got buckets for each of these things, that the types of environments that will potentially protect you from an inflation, a deflation, a recession, or just like a slow growth period.
So my 95% Bitcoin is slightly risky.
I don't know. Like, if I was, from a very like personalized position, I don't know. Like maybe you've got some stuff going on that totally justifies that. I have no idea. But
gotta have skin in the game.
Probably not.
Yeah, no, I haven't. I'm a terrible investor.
For me, I'm not a maximalist of anything. That's kind of like my default, which I know some people are going to be like, oh, that's so boring. And
yeah, but you're managing people's money.
Right. Like I'm a fiduciary. Like I'm responsible for other people's money. So when somebody comes to me and is like, should I put 95% of my money in Bitcoin? I'm like, well, if Bitcoin fell by 80% in the next 3 years, how would you feel? And for the vast majority of people, you might have a totally different situation where you can live through that. And, depending on your personal finances, like that might be a totally sustainable drawdown for you. And it obviously has been at some point, right? You've gone through and benefited from big declines. And that's...
Well, actually, I wasn't 95%. What happens is the market's done a
it grows so much. You get into a whole other debate about...
So that's changed my...
Yeah, so that...
But I hold no stocks and no bonds. So I own real estate and Bitcoin.
Well, so that's a really interesting discussion with everything that's happened in Bitcoin in the last couple of years, because you get this, like for somebody that has a really boring risk profile even, and I start from like a financial planning based perspective when I work with people, and if you built even a relatively boring asset allocation in Bitcoin of like, say 10%, 2-3 years ago, what's that position now relative to all your other stuff? It's probably way over 50%. So you've got this like portfolio skew because of the outperformance of Bitcoin in your portfolio that depending on who you are, maybe that's totally fine. I have friends who that has literally happened to, and they're totally fine with that, obviously, super happy. But if you're 65 years old and you're retired and you are living on like a fixed income and let's say maybe you've got some health issues or something like that, and you need some, balance in your portfolio, you need things to be somewhat stable. Well, all of a sudden you've got this 50% allocation in a portfolio that it fucks a lot of things up potentially.
It can do. I like the roller coaster.
So, I mean, which is for certain people, especially like, I say for people under the age of, like, the lazy rule in traditional finance is like put your age in bonds. And I've always been like, that's stupid. Like, it actually, if you're under the age of like 55, it probably makes no sense to own any bonds because you just don't have the need for that amount of insulation from. To me, bonds are basically they're protection from deflation mostly. And so bonds typically do well in a deflationary environment. So looking at, like, I don't know if you're familiar with like the Harry Brown portfolio, but like
Nope.
He was famous for building this like really simple all-weather portfolio where it was basically 4 quadrants where you owned cash, treasury bonds, gold, and stocks. And those were your 4 quadrants. You put them in 25% allocations, set it and forget it, and it protected you from all different weather environments, basically. Cash was there for a recession, basically. Bonds were there for deflation. Your gold is there for inflation, and your stocks are there for growth periods. And so you kind of covered all your bases with this really simple, boring portfolio. And, I'd argue that increasingly the gold quadrant should be replaced with something like Bitcoin. But using that sort of simple methodology, you've got kind of all of your bases covered across different environments where you don't have to get brain damage thinking about, what your different allocations are. And you can kind of, depending on who you are, like you can rebalance back to that allocation every year, just keep things super clean. And, you can reduce that risk of portfolio skew where you get these like, outsized changes in a certain asset, creating excessive amounts of volatility in your portfolio over time.
Right. So let's talk about your thoughts on Bitcoin, because I went onto Twitter, I did a search for Cullen Roche and looked up the word Bitcoin, and it feels to me that it's a gradual warming.
Yeah.
You don't hate it, you don't love it. And I'm more interested in your view on Bitcoin than 90% of the people I interview, because if I say to them, they're like, yeah, I'm all in Bitcoin. I've sold everything. I've sold my fucking house. I sold my car. Like, all my money's in Bitcoin. And it's like, I'm similar to that. And we've all got this kind of moonshot, but we all understand the economics of Bitcoin. We understand the up and down, but like, we're all the fucking same. We're all degenerates and taking a huge moonshot. But I'm interested in yours because you are an asset manager. So you have a fiduciary responsibility. As part of that,
you laugh, but you've been so right that like, and this is the thing, you've been so right that, I've never been anti-Bitcoin or anti-crypto or anything really. I'm not just like I'm not a maximalist, I'm not anti anything either. Yeah. And in fact, I mean, kind of, this is a little bit of a tangent, but to me, one of the beauties of Bitcoin and everything that's happening in the crypto space right now is that it validates a theory of money that I've always thought was a lot more accurate than some of the more like statist views of money, where a lot of people will argue that money has value because governments have guns and and armies, and they kind of like, basically lock us up in this system, and they construct it in a way that forces you to use it. And then they point the guns at you and they say, pay us taxes, and, that's it. Whereas there's a famous economist from UCLA named Hal Varian, whose theory of money basically was that, why he wrote an article like 25 years ago asking, why does that piece of paper in your wallet have any value? And he was questioning this theory that like a lot of people say that money has value because it says, debt of the Federal Reserve on it or something. And his theory was that it was all about a network effect, that basically a group of people, they get together and they agree whatever this thing is, it's money. And when enough people agree that that thing is money, it becomes money.
Like cigarettes in a prison.
Totally. So, it's Bitcoin is so, 10 years ago, working from that theory, I would have looked at, and I did look at Bitcoin, and I would have said, well, this thing has a really low level of moneyness. The network effect just isn't that strong. And, today you can't deny it. You cannot deny that network effect is huge and powerful and
Passionate. Passionate.
Well, but it's been right.
Yeah.
Like coming from like a really like strict market-based perspective, like you cannot deny that this thing that did not exist 15 years ago has now become a multi-trillion-dollar market. Like you can't ignore that thing. But from a theoretical money perspective, to me, it's just so much more interesting because to me, in a lot of ways, Bitcoin debunks like a lot of the statist theories of money, where people argue that, like the MMT people argue that, they argued that taxes drive money, that basically there's demand for money because people have to pay their taxes, which is probably true, I guess, to some degree. Like there's a function of a network effect in the sense that, when enough people agree to build a rules-based system around a currency like the dollar, I mean, yeah, people are going to use that thing because they trust it. They know that, I know if I borrow money from you and, you fuck me over, I know I can take you to court. That's pretty powerful.
Yep.
Like that gives me trust in using that money. And that's, I guess, government-based to some degree. But to me, the network effect theory is so much more interesting and to me valid because it's so much more free market based.
Well, Bitcoin has something similar, but it's different. You say you can give me money if I fuck you over, you can take me to court. You have that protection of that structure. Bitcoin's protection is more mathematical. The thing I like about it is a different set of rules. The rules of consensus is that I know there will be 21 million, and I know I can secure it myself, and I know my wealth is now mobile. I can take my Bitcoin to anywhere in the world and get liquidity. So it's just a different set of rules I get to play by. But the network effect is based on the people who also agree that those rules are good for Bitcoin.
Well, that's part of it is that, the government can't come in with Bitcoin and change the rules in the ninth inning. So like the last couple of years, I feel like a lot of people think the rules kind of got changed in the dollar system.
Yep.
And they did. Like the rules got totally shifted. And, which is, I don't know, that another tangent of mine is that like I've always, being more of like a free market guy, I understand there's a need for government, and it makes practical sense. Like someone's got to be there to put out the fires, and someone's got to be there to fight the wars at times. And there's a lot of this makes sense. The purely free market system, it's just not a reality. Like that system doesn't exist anywhere. Like governments exist, I think, for more practical purposes than not.
Yeah, I think it's two. There's another reason. There is the practical reasons. I also think it's a natural evolution of how humans organize themselves. And we end up with one or two versions. We either end up with a dictator or we end up with some form of a democracy. But I think it's just humans need ways to organize themselves. And I think, I talk about the libertarian red button. If you could press that button and you could switch off government, it was gone, and everybody was then free to do as they choose, they would end up organizing themselves again, and we would probably end up with something very similar to what we have now.
But so what's interesting now is that, and you see this increasingly in the United States, like I would have argued 10, 15 years ago that one of the beauties of the reason the US system has worked as well as it has is because it's actually a pretty fragmented system. It's a pretty decentralized system in terms of power structures.
Yeah.
Like Donald Trump can't come in and take over the whole government no matter how hard he tries.
And he tried.
But it's interesting because like you have real checks and balances in a government like the United States, which is good. It's also increasingly weird because you see periods where this power consolidates and big things happen. Like I was really critical of Obama in 2008 when he passed the Affordable Care Act, mainly because I said there were a lot of things we could have done for the economy that instead of doing things for the economy, they came in and basically passed like the Affordable Care Act. which was like kind of like his big idea, and which, I'm not a healthcare professional. Maybe that's a great idea in the long run. I have no idea. But at the time, like to me, that seemed like kind of a power grab. And you get instances of this where all three houses consolidate to one party, and then you get this big power grab, and you get a big move that it pisses off the other 50%, and you get this kind of like really like unproductive pendulum swing that seems to be going on, where you've got power grabs increasingly and big policies coming from that side that it kind of in a lot of ways, like the founding fathers of the United States, they wanted us to disagree so that we'd have to come to agreements. And you see that happening less and less now, which is, obviously it's like one of the weaknesses of having a system where people are hyper involved in a really discretionary way. And I wish that, especially with things like Federal Reserve policy and fiscal policy, that things were just more automated. And this is one of the beauties of the sort of like crypto-based system and the Bitcoin system, is that things are just automated. They just are what they are. And you can't really mess with that too much. There's not a lot of discretion involved there's no discretion involved in the monetary policy of Bitcoin. Whereas the monetary policy of the dollar is basically like Jerome Powell coming out and being, holding a finger up and being like, well, I think inflation is going to be 4% next year, so this is what we're going to do. And it's like, that's a bullshit approach to a large degree.
I tell you what I wish. I wish in the UK we were a republic. And this big push for states' rights recently, I think is a really interesting part of what you have here in the US. There's a lot I disagree with, of course, but this ability just to move, to get up and move to a new state. And I know it's not easy for everyone, but the fact that you can, because there's different rules that you can, but I like that. And so that is one of your strengths as well. We don't have that. I think your federal government has got too big.
Yeah, I totally agree. And a lot of that is that function of this discretion that we have over the ability to change the size of the government at any given time. And I think there's a really strong argument that the amount of discretion that we have, especially in periods of turmoil, is just way too much. Because here's the other thing. Policy in the U.S. is automated to some degree. Like one of the things that a lot of people who aren't directly involved in like understanding economics and fiscal policy is that when, for instance, a recession happens, what happens basically is really simple. The government runs a policy where they provide unemployment benefits, and the demand for unemployment benefits increases during a recession, and tax receipts decline. So by definition, the government's deficit is likely to increase because these automatic spending policies, we call them automatic stabilizers in economics, they automatically increase.
What do you do if that situation happens for you at home?
For what?
If you're running a business or running a home, what happens in that situation? You have to tighten your belts.
Yeah.
Maybe if you run a company, you have to let people go. It seems like government never shrinks, even at times of economic difficulty, which is, I think, one of the major problems of government. They don't have to keep to a budget like you do, Jeremy does, I do, like my company does. And that is one of the biggest problems.
Yeah, and I don't know, I don't know how you fix that.
No.
Because
I think you need more libertarians in politics, and they hate politics.
I saw it really like on the ground when I built a home like 2 years ago, and when I was going through the permitting process, I saw the way that the incentive structure is designed inside of like the local government, where there's no incentive to ever shrink this thing. The only incentive is to increase this thing. And in a lot of ways, it's counterproductive to actually being able to build, because as you expand this thing and it becomes more and more complex, obviously the rules get more complex, and little things that should actually be really simple involved in building something as simple as a house become really, really complex. And then you get these great big problems like housing shortages in California, where now people can barely even afford to live in the state, and you have huge homeless problems and all these like knock-on effects that kind of like come off of these things that it's weird. I don't know how you fix that.
Oh, fuck knows.
I don't. That's it's one of the things I just I hate thinking about politics, in part because like I don't have good answers for how to fix this stuff. You know, like would blowing the whole thing up, you know, and trying to start from scratch, would that be the right answer? Like, I don't know. I mean, or would that just like cause all these other problems that like?
Well, this goes back to the Bitcoiners. What the Bitcoiners think is that they've just found a way to route around the government now. It's like, okay, we can't control you. We can't control your size. We can't control what you're going to do with money. We can't control the influence that you'll have on us. You know, voting doesn't make a huge difference in a number of places, especially in the US. In some ways, it does in the UK because, you know, the power switches from one to the other every, you know, 4 to 10 years, whatever. In the US, some places you live, it's always going to be red or it's always going to be blue. So your vote actually has no meaning. But the Bitcoin is like, you know, we're just going to route around you. We're just going to create our own financial system, you know, our own economy. And we're going to do this with Bitcoin, which is, again, coming back to why I'm interested to talk to you about it. But I think a good question for you would be, is you are somebody who manages other people's financial assets. How much are you being asked about Bitcoin now? And can you even talk about the advice you give with regards to Bitcoin? Because I did notice in one of your tweets, you know, I'd see one tweet and there you are arguing Pierre Rochard, and the next one you're saying if you want to protect your wealth, you'd had a list of things of which Bitcoin was one of them.
Yeah.
So you obviously believe in Bitcoin.
Yeah. I mean, it's hard. I mean, I work with individuals, and I mean we have products that are publicly listed, so it's. I mean, I don't know. It's at a very like personalized level. Like I approach it the same way that I would, you know, talk about inflation with people. You have to. I mean, this stuff is highly, highly personalized. Like nobody's financial situation is the same. A 25-year-old who's single, you know, with a high income, has a totally different financial picture than a 65-year-old who's retired with health problems, living on a fixed income. Those two people's financial assets are going to be totally customized in very different ways. So it's hard to generalize about this stuff. I like approaching it from this sort of very efficient market view, or using something even as simple as like the Harry Brown approach, because it just creates nice, clean buckets to asset allocation where you're not hyper exposed to anything. I think that's just where I tend to get worried, because I spend my time worrying about other people's money and the volatility of other people's money. Like that's the thing that, like, I approach financial management from a very like behavioral finance perspective. To me, most people, they want all the upside and they don't think about the trauma of the downside and the risks of the downside. And even just owning too much of like the NASDAQ can be a huge, huge problem for somebody, because people don't fully understand that when the shit hits the fan in the tech market, things can go really, really bad. You know, the NASDAQ can fall, you know, what did it fall in 2000? 85% or something? If you've got all your financial assets there, those are huge traumatic declines that, even if they're just temporary events for somebody, behaviorally, they expose you to huge amounts of financial risk that, for me, I don't think most people need that amount of risk. Like, you can build a really diversified portfolio that holds things like, you know, Bitcoin and these other like really volatile assets that don't overexpose you to the amount of volatility. So
I've been through a 90% drawdown. It's rough.
Yeah, I mean and you're lucky, because if you're somebody that can go through that and weather it and know like, oh, this isn't ruining me financially.
No, it nearly did. I was 2 weeks from losing my house. Like, I've been through it. I'm okay now, but like, I've been through it. And yeah, I'm a big Bitcoin believer, and I might be overexposed, but I can handle another 90% drawdown because I have a solid business. But I do worry about people overexposing themselves to Bitcoin who aren't in that position. You know, for example, during this bull market, I took out a loan, bit of fun. When the price dumped to 17K, I took out what was the biggest loan I could get at that moment from the bank to buy Bitcoin. And I did. I bought another 2.5 Bitcoin. That was a great decision. Other people have come to me to say, you know, should I do the same? But I don't think they're in the same financial position. And it's super risky.
And that's the thing. Like, if you're someone let's say you're a college student who, let's say you have no income. Maybe you have student loans and, you're borrowing money to speculate on, whether it's GameStop or Bitcoin. It doesn't matter. Like to me, an excessive amount of volatility in a portfolio creates not just the portfolio skew that we were talking about in your overall asset allocation. It creates a hyper amount of, for certain people, it creates just a hyper amount of behavioral risk. And that's the biggest risk is, do you find yourself in a situation like the 2018 drawdown where things are getting pretty hairy and let's say like this is what happened in the financial crisis. A lot of the times when stuff like that's happening, there's a lot of other fucked up stuff happening. People are losing their job. And so like in 2008, 2009, when people were losing their homes, they weren't just losing their homes. Their stock market valuations were also falling. So their overall portfolio is falling and they're losing their job. And you get this kind of like, in a real recession, you get this compounding effect from all of the stuff that's going on, where the worst thing that can happen to somebody is being forced into liquidation of an asset, that, especially an asset that they believe in the long run. Mm-hmm. So if you had been forced into liquidating your Bitcoin position, like imagine the real long-term loss at that. And that that could be a function of just being over leveraged. It could be a function of just your own behavior, where a lot of people, they get into a big drawdown like that and they just psychologically, they reach a breaking point where they don't know what their max pain point is. And, that's one of the questions that I try to work with people on is, what is your max pain point? Because for most people, their max pain point it's much, much lower than they probably really think. Most people could not really sustain seeing their overall financial assets go down 50% for a sustained like 3 to 5 year period. They'd reach a breaking point in there at some point where they'd say, this isn't worth it. My personal life is a mess. My wife is screaming at me every day about the portfolio value, and I'm going to cut it loose just to make the pain go away. And that's the psychology that happens to a lot of people inside of big drawdowns. And, I'm not a critic of Bitcoin as much as I would say that I can be critical of being overexposed, of being just overexposed to any financial asset. And Bitcoin just happens to be a really volatile asset that I think you just have to be careful with. That's my default view with it.
What do you think of Bitcoin as an asset, though, and a little bit more than that, actually? What do you think more of the Bitcoin community? Because I've watched you in discussions, and it seems like you are trying to offer pragmatic advice and getting trolled back sometimes. What do you think we have wrong?
I think that there are so many good arguments for Bitcoin.
Yeah.
I mean, a ton.
Yeah.
And I've made them on my website for years and years. There are also, I think, really bad ones.
But this is why I really want to talk to you, because I think you're more practical.
Like, I think that, like, the Jack Dorsey thing, I thought that was a bad showing.
The hyperinflation
prediction. I just, maybe if we lived in Zimbabwe or something like that, to me, in the United States, the odds of actually getting hyperinflation in the United States, I think they're astronomically low. I wouldn't be shocked if people look back in 5 years and, are saying that was like an all-time bad prediction.
Yeah.
So, there are times where I see arguments like that. And I think sometimes like a lot of the Bitcoin people pushed back on me because I basically wrote a big research piece coming after that basically said like, the odds of continued high-ish inflation are relatively high. Like I think we're going to see 6% CPI well into next year.
Okay.
And then I think it's going to start to kind of moderate. It's not going to fall as much as the Fed thinks, but I don't think we're in this like escape velocity environment where inflation's like going to be 6% and then like
10,
go
20,
crazy.
Yeah.
So I don't know. I could end up being the one who's totally full of shit, but I don't think that tends to be one of the best arguments for Bitcoin, at least Bitcoiners in the developed world.
Yeah.
Like Alex Gladstein and I interact a lot, and he's always making the argument, which is arguably one of the like strongest use cases for Bitcoin, that if you don't live in the United States or a developed world country, you almost need to own this thing.
His arguments evolved to that, and he talks a lot about Tether as well.
Yeah.
Because I think Tether gives you stability for short term, and Bitcoin gives you something to hold long term.
It's funny. So this client I was having dinner with last night, he's from Istanbul.
Yeah. Whew.
And his whole family lives in Istanbul.
Yeah.
And like, I mean, he lives in the States. He's lived in the States for a long time, and he does very well. And his family is lucky because he's been basically giving them financial advice to hold dollars and to hold, kind of, crypto-related assets to some degree. But it's a fucked up situation because even though his family is kind of financially insulated, everybody around him is getting nuked.
Yeah.
And it's a horrific situation. And this is mostly government driven.
Dictator's going to dictate.
Yeah. And so, being in a situation like that, if Jack Dorsey were running Twitter based in Istanbul, I probably would be a lot more sympathetic to the view. Whereas here in the United States, to me, the high inflation argument as a Bitcoin hedge in the United States is not nearly as strong as it would be if I were somebody who was holding assets in another currency, especially a government that was a dictatorship or a place where somebody can really come in and just kind of unilaterally like decimate the economy with a bunch of bad decisions, which is essentially what Erdogan has done in Turkey.
That Turkey situation is desperate. I was talking about it, I think maybe even yesterday, saying that there is a chance places like, I could be completely wrong, but there's the chance that places like Turkey become dollarized but bottom up through people just converting their lira into tethers or other digital dollars. You've got to be looking for an escape valve there right now.
It's really, the rise of Bitcoin and stable coins is really interesting in the perspective of all of these emerging market economies, because to some degree, it makes me wonder if the rise of those markets is accelerating the decline of a lot of those currencies in some ways.
I can understand that.
You've provided a viable alternative that it'll be really interesting to see what happens politically and economically in a lot of these economies in the next 10, 20 years, because in a way, Bitcoin is sort of forcing a more free market onto these emerging markets that, frankly, they need it. They need to evolve into a more free market-based system or a more democratic type of government that, at least to some degree, relative to the way they are now, it decentralizes the power across it so that you can't just have some crazy guy come in and blow everything up because he's got some, special fetish with certain economic policies,
Yeah, I was with Matt Stoller in DC recently. Do you know Matt Stoller?
Yeah.
Yeah, and really interesting conversation. I like Matt. I like to listen to him talk about his like anti-monopoly position. But my point to him was that, because he thinks Bitcoin should be banned. He thinks that's not the way to fix democracy is with something like Bitcoin. He thinks it's a threat to Bitcoin. But I said to him, that's also a monopoly position, because actually not, allowing for Bitcoin allows for, a free market for money. And it's another check and balance on government in that if economic policy as it is in Turkey is being nuked right now, if the currency is being nuked, you have that escape valve. And isn't that a great thing for people to have?
Yeah, totally. And Nick Carter touched on this the other day when you guys did your interview, that in a weird way, banning it makes it stronger in a lot of ways, which is...
Well, China.
Yeah.
What a
Like, who would have thought?
Yeah, I fully expect China to reverse their policy at some point, somehow. Because they've just nuked Bitcoin within China. People are still using it, but they've nuked it within China. But the rest of the world is carrying on.
China's surprise. It was weird. I thought that it looked like in the early 2000s and after the financial crisis that they were making more of a push towards kind of like open economies, and I don't know. It's one of those, like, China's one of those outlier things where there's a lot of weird stuff going on in China where, I mean, shit, people think that supply chains are messed up now. Like, imagine what's going to happen to supply chains if China starts, dropping bombs in Taiwan. And you've got the entire Pacific Ocean there becomes closed off. That would be, in terms of like thinking of like outlier inflation risks and stuff, to me, that's one that really worries me. But just a lot of the trends in China in general are worrisome because you see them kind of, to me, like the development of the Bitcoin world in China was a good thing.
Of course, yeah.
And so seeing them ban it, I don't know what's going to happen, but it's they seem to be backpedaling in a lot of ways that are counterproductive.
Yeah, I mean, I think it depends what Xi does. I think isn't his term up for renewal soon? And I mean, I don't understand Chinese politics.
I don't even know.
I think it is, and he's standing on the precipice with the Chinese economy now. It's like, does he want to stamp his period in time and have his statues around China, or does he want to hand this fucked economy over to somebody else? I don't know. I know they're pulling back on their Belt and Road Initiative because they don't have the money now to lend out.
Yeah.
It's a whole other discussion.
Yeah, you could literally talk to somebody who's an actual expert about China.
Yeah. Well, we've got Lynn and Alden in tomorrow, and she's an expert on everything. So I'll be asking her. So like, just a final question, just to round this all up. I think, it is a weird time. You are a pragmatic capitalist. If you were advising people now, people listening to the show saying, thinking about the economy and inflation, what's your kind of like best advice you give to people right now?
Times like this, I think that with all the uncertainty, it makes a lot of sense to be really broadly diversified across things, because the range of outcomes, I mean, I would argue that the range of possible outcomes right now are more uncertain than maybe they've ever been. Mm-hmm. Like, you could have on the one end of the spectrum, I could be totally wrong about my inflation prediction that, maybe we are in this period of escape velocity where, you get 6% CPI going into, Q2 next year, and then all of a sudden, like, it just kind of starts to tick higher and higher and higher and higher. That could totally happen. I wouldn't put like, high probabilities on it, but I wouldn't say it's 0%, certainly. Could the market crash? Could the real estate market fall completely apart in the next couple of years? Wouldn't surprise me. So I don't, there's periods in the economy where I think you can look at things and you can, like 2015, like a period like that, you can kind of look at it and say like, outside of like a pandemic or something that's just like a total like, blind shot over your shoulder or something like that looked pretty boring. And it was like, there's nothing crazy going on with government policy. Like, the economy is just kind of chugging along. And so for a lot of the period of like 2010 to 2020, I was like, we're just in a muddle through period. That's just the way things are going to be. It's just people are going to get up and go to work and build things, and nothing's going to be spectacular, but it's not going to fall apart. Whereas right now, you can look at things and you can make valid arguments in like any direction. I could see things muddling along for a little bit. I could also see things hyperinflating. I could see things deflating. And so, like, just using that like range of probable outcomes, like, to me, it leaves me being like, I don't know. I have no idea what's going to happen. The range of outcomes is so wide that for me personally, like, I want to own a little bit of everything. And that's the way that I would approach the world over the next 5 to 10 years. And that way you kind of insulate yourself from, all these range of outcomes, whether it's something that ends up being hyper extreme in one direction or the other. You're pretty all weathered from all these things.
Awesome. All right. Tell people where they can follow you, where they can buy your book.
Twitter, Cullen Roche. And then my website is Pragmatic Capitalism. It's pragcap.com. That's where I write most of my sort of like weekly musings and bullshit narratives about what I think is going on. But those are probably the two best places. So,
well, listen, I appreciate you coming on. Maybe we'll do this another 6 months to a year, and we can reflect and go, "Oh, well, this is what happened."
Yeah, but when you're in California, you should come through, and I'll show you the North San Diego area. It's pretty awesome.
I love the whole stretch of California. Each bit for different reasons.
Yeah.
I mean, I haven't been to San Francisco much recently, but I'm a big fan of LA. I love San Diego.
If you like LA, you'll love San Diego because it's basically San Diego is a smaller, just a lot more laid back version of LA, basically.
Yeah, I like it. I like the food down there.
Yeah.
Yeah. Brilliant. Well, listen, thanks for coming in, man.
Yeah.
Take care.
Thanks for having me on.